Eli, is anyone on their way? You didn't see anyone? Very interesting. Then I take it we're ready to start. Are we rolling? All right, this is being filmed for people that can't be present. So, today the title of this presentation on the Symposium website is Gauging the Volatility of the AI market, the modern day AI market, by comparing it to the dot-com bubble and crash of 2000. And I don't expect you to know exactly what that means, which is why we'll get into it. I want to review our abstract. You don't have to read all of this, but what I want to encourage is an open mind, right? This is a presentation catered toward people who are less knowledgeable on the subject, and I think people from that perspective can tend to count themselves out of talking about AI and technology and what's going on in the economy. And I think this is the wrong perspective to take. I think people should be approaching ready to learn, approaching ready to be participators and involving themselves in conversations of this nature, which I think is a big part of just being a good friend, a good citizen. A good Christian is knowing what's going on in the world around you and being able to comment on that and having a valuable opinion. And I do want to start my timer so I know how long I'm taking. Right, so with that said, we have a little bit of a roadmap for you. We're going to introduce to you the dot-com bubble. What is that? What happened in 2000? Talk about the AI landscape of what's going on today and draw comparisons of where can we find connections, similarities, and dissimilarities. Right, so the dot-com crash, there's a lot going on here. This was a period of economic uncertainty kind of starting in the mid-90s and culminating in the pop in 2000, right? And a bubble, let's start with that. A bubble is a period where there's a large discrepancy between the true worth of something and its evaluation. So its perceived value is going up and up and up, and its true worth is not that. And this is a phenomenon that tends to surround uncertainty and fads and things that are new and novel and different, which is why they're common in a tech sector, because tech tends to have a lot of innovation that's kind of fast and catches the world by storm. And what we're seeing here is the fad is business moving online, right? In 2000, companies like Amazon, Nokia, it's growing in popularity of online retail, and just generally the digital age is what's coming about. And companies that are involved in the dot-com bubble around this time are very young relative to the amount of money they're making and the amount of investors they're receiving. And this creates for a process where they're not yet profitable. They need to be making money, and they need to grow in order to start making money. They need to start scaling their business to get the ball rolling on these profits. And so they go to investors, they get money in hopes of becoming profitable, and this does not happen, right? Which is how eventually the true value of the company is realized and worth plummets, and it's bad for everyone involved. And another key trait to the dot-com bubble is specifically surrounding the IPOs during this time. This is our first vocab word. You don't have to remember it, but IPOs is when it's an initial public offering. It's when a company goes public for the first time, when it first becomes a tradable stock on the stock market. And what was happening during this time was underpricing, where companies value their initial stock probably below what a lot of people think it would be, which draws a lot of early attention to get on this cheap stock that shows a lot of potential for growth. And so when they first go public, they see an initial jump in their value because they undervalued it to begin with, which kind of brings unwarranted attention that wouldn't have happened otherwise. And the IPO kind of does that by nature, drawing attention and causing a short burst of profits. But during this time, rather than using the IPO as a statement of stability of the company, they were using it as a way to get attention and money, which is not what you want to do, right? And covering some more numbers on this subject, we see the average age at IPO dropping. Companies are going public younger and younger. We see percentage owned by CEO cutting in half, and percentage of companies with investment banks as underwriters and shareholders going up. These two numbers work in tandem, right? As we have investors looking to invest in young startups, young companies, what happens is it's kind of like Shark Tank. They offer their money in exchange for a proportion of the company. I'm going to give you whatever, $500,000 for 10%. And that's what Mark Cuban says. And that's what's going on here. And when they issue those new shares to investors, then the relative percentage of shares that was owned by the CEO goes down, which dilutes the stock. It's called dilution, where the overall ownership of who's a stakeholder in the company kind of gets thinner and spreads out. And everyone has a little bit less stake in it as new investors come along, which is natural to growth in a company a lot of times. This is very typical. It's just that when it happens at a rapid rate, and when it isn't paired by rising valuations, then it can look like just kind of frantically seeking investors rather than being ready for that step. And also we see income dropping a lot. And this doesn't necessarily mean companies are losing millions of dollars. It just means they're spending so much that that gap has to be made up by more investors because their profits haven't made up for where they should be at that time. And so looking into the AI market, what's going on now? I want to emphasize 3 different types of companies. We have kind of our well-known, that have been around for a while, make a ton of money, large cap companies. And these sometimes are involved in software, but are also involved in AI infrastructure, which is like chips and data centers and other stuff of that nature, which is also kind of a key part to what's going on. And then we have our young superstars that kind of bear resemblance to these larger companies in terms of the money they're making and the money they're moving around, but are very young, and it's very much of an anomaly for them to be kind of doing the kind of numbers they're doing. And then we have kind of our more typically what you would expect from a startup of they're just getting off the ground, they're kind of modest in the amount of money they're making, and they're still growing. And these are the companies we want to pay attention to. And this is a poorly formatted slide to show you that there is a lot of companies in those groups 2 and 3, companies that are very young, that are just getting off the ground. It's just a very dense market with a lot of attention. The narrative kind of is that there's a key few, like OpenAI and Anthropic, that are stealing all the attention from the others, and they're kind of, rising above the rest, which is true, but all of these companies are receiving, millions of dollars in funding, and it's just a very large movement that's been going on in the past couple of years, right? It says, I think there's more than 50 on this list, 45 are 10 years old or younger. Just a lot of kind of convergence on one phenomenon. And so looking at our first point of comparison, we were talking about how the companies were IPOing very young back in 2000. So what's going on now? Looking at our older companies that we mentioned before, the Microsoft and the NVIDIA and the Palantir, they're all quite old, and they've all long since IPO'd. And they IPO'd, some of them around average look like maybe a younger age than what you would expect. But it's been so long since they've IPO'd that you can't really assume that that was a bad move because something bad would have happened already. And so we can't necessarily take that as a metric and say that that is a cause for concern looking at the AI-involved companies today. And looking at our younger companies, none of them have IPO'd. I'm pretty sure on this list, they're all private, to my knowledge, if I checked correctly, which is a good thing. It means they're sitting back, they're waiting to make that move until they're profitable and they're trustworthy, and they're not kind of jumping the gun on that, which is a good sign. And it means that maybe the AI market's not in trouble after all, which we like to see. But it also means it's not an indicator of similarity yet. Going back to dilution, I mentioned how we see during 2000 ownership structure kind of getting stretched thin, as I mentioned. And I mentioned investment banks. Here it's a little bit more relevant to emphasize the role of venture capitalist firms, but they're playing relatively the same role where as we see VCs, venture capitalist firms, investing more and more, then the significant shareholders prior to those investments have a relatively lower percentage. Same phenomenon. The thing is, however, we actually don't know what the ownership structure is of any private companies because since they're private, they're not forced to make that information public. And so how do we know that dilution is still happening in these smaller companies? We can kind of work backwards and see, well, they're receiving funding, so they must be putting up shares to make that funding happening. And in some cases, they're receiving so much funding that they must be going through dramatic dilution. And so we don't actually know on this list if there's any kind of like I said, dramatic dilution going on, but some of them have received so much funding, you can only assume that they're at a point where the CEO maybe only owns 1 or 2% of the company, which is a remarkably low number for being so young. Right? So that certainly is a point of similarity that we can be conclusive of. And again, it's kind of contextual of if dilution is bad. Maybe they're just growing at a healthy rate. Maybe they're living beyond their means. And it's kind of, again, contextual to, are they growing in valuation? Are their profits kind of growing in accordance with that? And that's what you need to look out for. And then I also have this list of frequent venture capitalist firms that I've seen a lot that are involving themselves with AI. And I want to point out the last 3. These are all AI companies of their own that like to invest in the startups within their own sector, which is an interesting thing that I'll come back to later. Right? Now we're going to look a little bit back to our larger companies, our Microsoft, NVIDIA, Palantir, everything that's going on there. They are working in AI infrastructure, building data centers, very expensive. They're racking up debt to do so, pretty much. They have this weird system in place where they want to build a data center, let's say, and they don't want to take on the debt. They don't want to take on the loan. So they ask a middleman company to build it for them, and the middleman company takes on the debt, and they promise to rent the infrastructure from the middleman company. And this plays with 2 numbers, capital expenditure and operating expenses. Capital expenditure is just the really important stuff you're spending money on and where a lot of your money is going. And operating expenses is just like keeping the lights on and more menial, kind of where the money might be going. And in this scenario, a massive loan would look like capital expenditure, but they're trying to replace that on their balance sheets with a lease, which would just look like operating expenses. And so they're trying to make the balance sheet look like they're not putting as much money toward these data centers as they actually are, which is a suspicious phenomenon, to say the least. And a trend that's going on in accordance with this, right? They're working with private credit firms. These are non-bank lenders. And there's this asset you can buy called a credit default swap, which is a hedge against private credit loans. So it's a bet that the loan will default. That's the bet. And bear with me. The spreads on the swaps are widening, meaning they're being perceived as riskier and riskier, meaning that a lot of investors are perceiving that the loans will be defaulted on when they mature, which is a very significant phenomenon to note. And there are different valuations. There's like prime and subprime, and the subprime are known to be less stable, more volatile loans. But nonetheless, they're being perceived as riskier, which makes them poor investments, which is, again, something to remember. Next, to move on to investors. We'll recap all at the end. This is where I start to feel like it gets to be a lot. We'll recap all at the end. Moving on to investors. We have 2 kinds of investors we want to look at. Retail investors, institutional investors. We really just want to look at retail investors, which are people who are investing with their own capital, which are the you and the me, guys trading in their basement, right? And they have a couple patterns that they display in looking at the dot-com bubble of how retail investors like to behave. And it actually makes them really good indicators for where a bubble is forming. And that's really interesting because we can look at 2026 and see where retail investorship numbers are going. We see that they went up from 2019 to 2023 across the whole market, right? People are investing more from their own money, which, okay. I think that has something to do with COVID, people being stuck at home. But looking specifically at NVIDIA and the amount of attention and money they're getting from retail investorship, oh my goodness, almost 9-fold, way huger. That is something to note. Retail investors clearly have recognized that the fad is somewhere, and it is AI. And so that if they are an indicator of bubble traits, bubble instances, then this is a bad look for AI companies of how much attention they're receiving from novice investors that presumably don't know what they're doing as much. Very important to note. This is our last point of similarity, a note on profits. We're going to focus specifically on OpenAI, and we'll expand a little bit to the greater market at large. OpenAI is projected to do, in 2026, $20 billion. This is a number known as ARR, Annualized Recurring Revenue. This is when you take your best 30 days and multiply it by 12 to make a projection for the year, which is not a scientific number at all. Oh no, come on. Hello? It means they're pretty much lying about 11 of the 12 months when they're trying to predict how much money they're going to make for the year, which, yeah, is not a scientific method of doing that. What's up with this? Where did the director of the symposium go?
Do you want me to see if I can?
You want to? Oh man. Yeah. So they're projected to do 20 billion. That's all we need to know. By 2030, they want to do 280 billion. That's a number that the CEO has said. That's a 14x in 4 years. That's ambitious. For a little bit of context, OpenAI, owning ChatGPT, they have a subscription-based ChatGPT service for $20 a month. Right? The most profitable, the best subscription-based service on earth, I'm pretty sure Netflix, does 40 billion in subscriptions. So if ChatGPT were to match the best on earth in terms of how well they're doing in their subscription service and how much attention they're receiving, they would still be far short of the 280 billion. ChatGPT also sells their software directly to businesses. It's called B2B sales, business to business. Salesforce is a company that's one of the most prolific in terms of B2B sales. They do 40 billion. If they matched both Netflix and Salesforce in those respective quantities, they would still be far short of the 280 billion number. Google does 265 billion in ad revenue. If they could match Google, they would get to that 280 billion number, right? That is 3 very lofty goals that I don't think will happen. There's not a lot of science behind this, but I think we can just look at that and objectively say that's ridiculous to be so successful in those 3 respective areas. I think the CEO has said they want to do 100 billion in ads by 2030, which again, not going to happen. And in total, across all their funding rounds, they've raised 180 billion, which is just to go back to, they're spending a lot. They're spending way more than what they make, and they do this through the funding rounds, through acquiring some debt, and also through all the funding. And I think something to look out for in the future is if we keep seeing funding rounds like these record-setting $120 billion rounds of funding, then I would start rolling my eyes at some point and ask, when does it end? And when do we actually see the company getting a move on? And this chart is a price over earnings chart. It's a ratio of the stock price of a company relative to its earnings per share, which is just a metric to quantify how good it is at earning money. And this ratio, you kind of expect the stock price and the earnings of the company to kind of move together. Whereas they make more, they're valued at more. But we see there was a large discrepancy in 2000. It bottoms out in 2008, where they're valuated very little and making very little. And then it's back up again now. So we saw in 2000 their valuation, the price of their stock, very high relative to how much they actually earned as a company. And it's not quite where it was in 2000, but very close. And that was the bubble, in case you forgot. And this, again, just very kind of uncanny similarity in what we're looking at here. Okay, so let's go through each point of similarity and talk about what we just talked about, right? So we talked about youth not being a huge concern. They're not IPOing, they're not going public, which is a good thing. They are making a lot of money and receiving a lot of investing for how young they are, which is a bit concerning. But just the fact that they're young isn't totally a huge problem. They are diluting, and their diluting is being paired with rising valuations, right? The economy is doing well just in terms of growing stock prices, right? Which kind of looks like a good thing, so we can't totally roll our eyes at it, but dilution is 100% happening. They're taking on debt, especially for the AI infrastructure companies. They're hiding this debt in the term of leases, but it's definitely happening. And investors are catching on because the credit default swaps are growing in popularity. Retail investment peaking in very similar ways. retail investors, the uneducated guys have correctly identified what's popular and what's trendy to invest in, and they've hopped on that, which, again, I wouldn't say the novice investors indicate the bubble, but you can look at every bubble and say, well, the novice investors clearly found it. And then profits, still largely weak relative to where we want them to be. Valuations are growing, funding rounds are continuing to happen, but the profits aren't following that in the way that you would hope. And so similar or not? Yeah, they're similar. Yeah. They're quite similar. Will what happened in 2000 happen now? I don't know. What did happen in 2000? That's the next slide. There were some consequences, and people that I've talked to that were maybe college or adult age, they saw it as a bit of a footnote in life. They're like, yeah, I read an article about that, but the dot-com bubble wasn't super memorable. Probably didn't change the price of milk or anything. The NASDAQ fell, and valuations fell, and a lot of money was lost in terms of perceived value during this time, which is certainly bad for investors and bad if you're a tech CEO, but not really bad for the you and me. And so if the exact same thing happened then that happens now, then I wouldn't say we have a ton to be worried about. It's bad, not that bad. There are other confounding variables, right? 9/11 happened shortly after. War in Afghanistan happened shortly after. And so you can't really look at the economy and say all of that bad stuff was caused by the dot-com bubble, because nothing is all caused by any one thing in like a global economic scope. So many confounding variables. And we have those too today. We're warring around. And there's a lot going on with oil and stuff, and precious metals too, I think, are weird right now. But similar scenario, right? And so what do we look out for? What can you take away from this? If you were to be scrolling your Apple News feed, what should you keep in the back of your mind? IPOs are not happening yet. Companies are not going public quite yet, but they will. SpaceX, I'm pretty sure, will happen this year. They have a whole logo for it, which will be really big, which will attract a lot of attention, make a lot of money for SpaceX in a kind of a short jolt of profits, and be a huge story, right? And good for them. And plenty of other companies I kind of see on the near horizon, maybe 2028, 2029, 2030. But it will happen eventually. They can't just wait forever. You do want to be public at some point, once investors can trust you. And so that'll be something really big to look out for. And then again, private credit loan maturation. See, that's kind of a more long-term thing. A lot of those loans I don't think mature until 5 years from now. But something to look out for. And then continued funding and continued lack of profits are just other things to look out for. Where if there's more record-setting funding rounds from Anthropic and AI, you can kind of look at that and think, when does it end? And you can assume that the profits must not be where they should be. And so what can we speculate about? People like to doomsday this kind of stuff all the time and think about what's going to happen. I have 3 theories that aren't mine personally, but I think are within the realm of possibility. I mentioned earlier that a lot of the larger AI-involved companies, large tech companies, like to dip down and invest in the startups. I see a possibility where a lot of acquisitions happen. Companies don't prove to be profitable, and they just get bought up, and everything's owned by Microsoft and Amazon at the end of the day, which is boring and probably won't result in much. Won't result in huge catastrophe, but I think is a possibility to look out for, and definitely a familiar outcome that we've seen in the past a lot. Or AI could take over just in certain sectors, right? I did see studies that compared the dot-com bubble to AI market, and they diagnosed that there was no sector-wide bubble, which is great, but they did say that certain companies showed definitive bubble trends, and just those companies might fare for the worse in the next coming years. And I think that is comforting in that it just brings into mind that it's not an all or nothing. It could be partial bad, partial good, change in some areas, maybe white collar kind of gets taken over, and those jobs change a lot in their nature, but most other jobs really aren't affected outside of the office space. And then finally, I did read one article that was very interesting describing automation leading to large, wide-scale unemployment, which causes a lot of people to not be able to spend as much money, which ends up wrapping back around to hurt the companies, and they have to start cost-cutting, and they automate more. And it's kind of describing this whole spiral of how we lead to what was intended to be partial automation and what leads to full automation. This assumes that AI can fully replace a human being, which I don't think it can. And I think this really is a doomsday scenario, kind of dystopian and sci-fi. But I just bring it up to remind us that a number of things are possible, and maybe a combination of truths and falses were spoken today that you can take away, and just be reminded that all kinds of things could happen. Right? And I want to just once again, like I said in the beginning, remind you that the point of this was to be paying more attention. Now you have some different metrics to look for where you can read the news, see what's going on, Google an article or two, and have an opinion on these type of things, maybe anticipate something that could happen, something that won't happen, something that might happen. All it is that you are more informed and you are more qualified to speak for yourself as a citizen, as a Christian, as a person. So that's all. Thank you. I will open it to questions if anyone's really pining. Fantastic. Yes, Ben.
I'm interested about the lenders, that the people that are investing in the plants that, like, OpenAI is trying to open up. They're trying to build their infrastructure, and that they're saying they're betting that the loans get defaulted on.
These are swaps. I didn't even mention The Big Short. I should have mentioned The Big Short. This is a movie about the 2008, I love the movie, 2008 housing crisis. And it's a very similar thing where there's a new asset that is created. In the movie, Michael Burry says, I want the bank, you, the bank, to create for me an asset where if I buy it, I'm betting against the mortgage bonds, the subprime mortgage loans. And it's the same thing. Yeah, it's kind of like life insurance a little bit, where you buy it and you're continually paying into these premiums in the hopes for the person dies, the loan defaults. That's the parallel. The loan defaults and you get this massive payout. And that's the bet. And I wasn't necessarily entirely sure if they were rising in popularity. I think they are. I think the whole private credit sector is kind of a weird thing right now. A lot of people like to bet against it. But specifically, private credit loans regarding AI infrastructure are being evaluated as riskier. Which, that statement in itself doesn't say a lot about what the investors are actually doing. Presumably.
The firms themselves are betting against the middleman to pay it back. Because the middleman is betting on the AI.
They're not doing this. They want the middleman to stay alive.
Correct.
Yes.
But the private credit firms are saying, I want you to die.
No, it's the private credit firm's loan. They're giving out the money.
So who wants it to default?
Investors who are buying the swaps.
What swaps?
These.
Sorry, I'm dumb, Joey.
So you would buy the swap like from a bank.
I see.
Like JP Morgan would issue you this asset, or whoever, I don't know, owns the loan.
Very strange.
Yes, Mr. Rick Road.
Is this the only parallel you see between the AI market today and the mortgage crisis? Are there other?
Is this the
I know
only?
It's not focused on, but
In terms of, I mean, just think about what I know from the mortgage crisis. The nature of it was a bit more nefarious, where the loans were within bonds that were kind of structured to deceive the investor into thinking that the bonds were legitimate. I think bonds are more typically interpreted as a safer asset than a singular loan. And it may be that the swaps are collections, are a hedge against a collection of loans. I wasn't entirely clear on that. I'd have to get back to you on that. These are all great questions.
That's a great great job by Joey Dunbar.
If that's all, I'll show you the thank you again.